Hi everyone. Today I bring you a new investment opportunity. It's a company called Cakebox Holdings. The company listed on the London Stock Exchange, and Cakebox, together with its subsidiaries, engages in the retail of fresh cream cakes in the United Kingdom. It offers cakes for celebration purposes in different designs, uh, and also offers seasonal cakes as well as wedding cakes. The company was founded in 2008 and is headquartered in London, the United Kingdom. The total analysis of Cakebox as a company will be built up from two videos. In the first video, I will talk about the business in general and evaluate the company by its free cash flow. And in the second video, I will talk about the business and the management quality in details. The second video will be released on Sunday, so stay tuned if you like the first video. So as you can see, they have a bunch of different cakes, vegan cakes, all the kind of celebration cakes, and they have a good customer reviews, 4.5 altogether on Trustpilot. So the customers are enjoying their cakes and the company's services. So now let's dig into the business. They have over 200 stores in the area of the United Kingdom. This is a bit older presentation, however, it sums up where are the stores currently. As it is visible, mainly it's in the area of London and the middle of England, around Manchester and that Midland areas. Mm, they really missing the stores in Scotland and other areas of UK and Wales. The management also identified that gap, and they are searching for new franchise opportunities and business partners in the area of Scotland, southwest and southwest of England. All in all, the store growth is pretty impressive. They more than doubled the number of stores since their IPO. Other than the stores, they have some kiosks. Most of them are in supermarkets. They are smaller sized selling areas. The new goal for the management is to reach 400 stores. They didn't say an exact date for that, but it will be a double from the current 205 stores. Now let's move on to the valuation template and evaluate the company, how much it can worth and how much return we can expect if we invest in that company. So here are some main metrics about the company and informations. Um, as I said, the industry is the food industry, and market cap is currently 54 million British pound. They have around 4 million pound debt and 7.3 million pound cash. So it means they have more cash than debt. They are in a negative net debt situation. This results that the enterprise value of the company is lower than the market cap of the company, which is a rare case, and it's a good thing, of course. The company do pay out dividends. It was costed in the last financial year 3.1 million pound for the company. This resulted 8.1 penny, and the The payout ratio was 71.7%. It's a pretty high payout ratio. However, it was not always that high for the company, and with growth, probably it will decrease a bit. Since the IPO, the company increased its dividend by 125%, from 3.6 penny to over 8 penny, which is a massive growth in 5 years. However, that big increase in dividend was made possible, but because also the payout ratio increased significantly. As you could see, at the end, it was already now like around 70%. So the dividend growth will decrease a bit, but it was a staggering growth in 5 years. But before continuing to evaluate the company, if you like that video, please subscribe to my channel and click on the like button. Thank you very much. But now let's go back to the current valuation metrics, and the price per earnings of the company and the price per free cash flow is around 12 and a half, and the enterprise value per free cash flow is around also 12, which results, yeah, an 8% free cash flow yield, which is pretty decent. And the enterprise value per EBITDA is around 7.5. And currently, you are paying around 3 times of the book value for the company, and the current dividend yield is almost 6%. So let's jump into the valuation. I built up a three case cash flow valuation template. There is a bear case, a middle case, and a bull case. In the bear case, I assuming 4% free cash flow growth rate for the next 10 years, and with a future multiple of 8. This is a very conservative case. We can expect at least, I think, that amount of growth with doubling the store numbers in the future. It's very likely that the company at least will be able to achieve that. In the middle projection, I'm expecting a faster growth rate in every year compared to the previous. However, um, faster in the beginning, the first 3 years around 10%, and then 7, and the last 3 years just 5%. The future multiple I increased to 12, which I believe it's reasonable for a faster growing company. And in the bull case, I assumed 15% growth in the first 6 years and then 10%. It is a bit exuberant, however, not impossible that the company can reach that. And if that happens, a 15 times future multiple at the end of 10 years can be reasonable. So let's check what is the end result, what we can expect. So in the base case, there is 4% margin of safety, which means we can basically expect a 10% return, as the discount rate was 10%, 10% yearly return for the next 10 years. And with the middle projection, the company is 55% undervalued currently. And with the bull case, the company is 165% and undervalued. Uh, so the stock price should be 165% higher currently. So, but let's play with a bit with the numbers. What does that mean on a yearly CAGR basis of expected return? So let's change the discount rate to around 16%, and this would result 7% margin of safety. So in that case, in the middle case, we can expect around 16% yearly return, and in the bull case, around 25%, which is a pretty compelling uh, opportunity in all of the cases. All in all, the average of the three scenarios is 2.3 British pound, which means a 75% margin of safety uh, for the current price, which is really impressive. And so the company definitely worth a further look. As a reference, the 10-year US Treasury is currently 4.93%. So this is a safe bet. 5%. We obviously need to expect more return from that company than that safe bond. With that, I'm finishing the first video. Stay tuned until Sunday if you would like to hear the rest of the analysis.